Hello everyone, I'm Carol Bennett. Today I'm standing here not just as a strategic wealth advisor with 13 years of specialized retirement planning under my belt, but as someone who wants to sit down with you, push aside the dry balance sheets for a moment, and talk directly to that heavy, suffocating feeling in your chest when you open your mailbox. The sheer, unadulterated tax fatigue of the American retiree. I know that feeling. It's that visceral tightening in your stomach when you watch your Social Security check, the very safety net you spent a lifetime funding hit your account, only to see a chunk of it instantly carved away by the government. It's the bitter resentment of looking at the home you spent 30 agonizing years paying off, sweating through extra shifts, sacrificing vacations just to give your kids a backyard, only to have the county send you a skyrocketing property tax bill every single year. It feels like a quiet, systemic threat. Pay up, or we will take your sanctuary. That is not just a financial drain, it is the erosion of your peace of mind. But I want you to stop right now and listen to me very carefully. Currently, there are 6 specific bills that millions of Americans over the age of 65 are dutifully, painfully paying every single month, when from a strict legal and statutory standpoint, they have an absolute liability of 0, not a single dime. Do you know what infuriates me the most? Over more than a decade in this industry, I have watched thousands of seniors, people who lived by the rules, paid their dues, and built this country quietly hand over their hard-earned wealth simply because they didn't know a single 7-word phrase. A phrase that the banks, the utility companies, the insurance conglomerates, and yes, even the Internal Revenue Service are praying you never utter. I am over 65. What am I exempt from? Those 7 words, my friends, are the barrier holding back an average of $3,400 to $9,200 a year in pure savings for the typical American senior. This isn't some shady loophole, and it isn't buried in invisible, microscopic fine print at the bottom of a 500-page prospectus. It is codified law. It is printed in plain text on official government documents. The financial institutions know you qualify. They have entire compliance departments. They have your date of birth on file. Yet, they choose institutional silence because your compliance fuels their bottom line. They are pocketing billions of dollars off your lack of information and your quiet resilience. This is deeply personal to me. I watched this happen to people I cared about. I remember Mr. Kowalski over in Hamilton County, Ohio. He spent 8 long years in retirement, overpaying thousands of dollars in property taxes because he had no idea he qualified for a local homestead exemption. His annual assessment notice arrived like clockwork, perfectly calculated, but it never included a line that said, "By the way, Mr. Kowalski, you are paying too much." He only discovered it 2 months before he passed away, during a casual chat with a neighbor at a church picnic. 8 years, $24,800, gone forever. I refused then, and I refuse now, to let that happen to you or anyone you love. So today, whether you are sitting on a comfortable 7-figure nest egg or living entirely on your fixed Social Security income, I need you to discard the mindset that these programs are only for someone else. Let's systematically dismantle these 6 financial drains right now, utilizing the absolute sharpest, cutting-edge tax weapons brought forth by the latest legislative wave under President Donald Trump. Bill Hassan. Federal income tax. Let's start with the big one, federal income taxes. A massive misconception among high net worth retirees and middle class seniors alike is that their CPA or their premium tax software has automatically optimized everything for them. It's a dangerous assumption. The One Big Beautiful Bill Act, ABBA, signed into law by President Donald Trump, introduced a monumental tax shift designed with a singular, aggressive economic philosophy. Leave the capital in the hands of the citizens to drive the economy. For retirees, this manifested as a highly potent provision known as the senior bonus deduction, which applies directly to the tax returns you are executing right now in 2026. Under this provision, every single filer aged 65 or older receives a massive additional deduction of $6,000. If you are a married couple filing jointly and both of you are over 65, that number scales up to a whopping $12,000. From a professional tax strategy standpoint, the sheer power of this mechanism lies in its stacking capability. It does not replace or phase out your existing deductions. It sits squarely on top of the standard deduction, which was extended by the Trump administration at $16,100 for single filers and $32,200 for married couples in 2026. And it stacks on top of the traditional aged 6, 5, and over standard deduction boost, $2,000 for single filers. Now, I know what some of you are thinking. Carol, I look at the updated Schedule 1A forms and it looks like an IRS trap. If I file this wrong, am I going to trigger an audit? I understand the institutional paranoia. The IRS uses complexity as a weapon of intimidation. But look at the mathematical reality in 2026. A single senior over 65 can now completely shield up to $24,100, $16,100, plus $2,000, plus $6,000 of income from federal taxes. A married couple, both over 65, can shield an incredible $47,400 of wealth from federal income tax. If you are on a modest fixed income, this drops your tax liability to absolute zero. If you are in a higher wealth bracket, you aren't left out. The phase-out thresholds for this bonus deduction are incredibly generous, protecting single filers making up to $75,000 and married couples up to $150,000 before the benefit gradually tapers off, disappearing completely at $175,000 and $250,000 respectively. Here is your high-level insider strategy. Do not let a lazy tax preparer gloss over this. Take last year's return, take a yellow highlighter, and mark your standard deduction line. When you sit down with your accountant, don't ask them if you qualify. Tell them, I want the 2026 senior bonus deduction applied under OBBBA to my Schedule 1. If your CPA looks at you blankly, stand up, take your documents, and find a real strategist. It is your money. You dictate the terms. Furthermore, if you are a high net worth individual whose tax liability is already minimized, do not just treat this $6,000 as a standard tax saving. Use it as a structural shield for a Roth IRA conversion. Convert exactly $6,000 from your traditional IRA to a Roth IRA and let this new deduction completely wipe out the conversion tax liability. You effectively shift pre-tax money into a permanently tax-free vehicle for your heirs at zero net tax cost today. But heed this warning. This bonus deduction is currently structured as a temporary provision set to sunset after 2028. If you do not actively claim it, or if your preparer fails to utilize the updated forms, the money reverts back to the Treasury. Do not let them remain silent with your capital. Bill #2, the Social Security Tax Trap. Let's move to the second bill, the widespread systemic misunderstanding of the Social Security tax structure. I constantly hear seniors say, well, the government always takes its cut of my Social Security, while others mistakenly believe it's entirely tax exempt. While the administration's initial policy goal was the complete elimination of income tax on Social Security benefits, Congress ultimately balanced the OBBA budget by implementing the senior bonus deduction we just discussed. This means the legacy formula for taxing Social Security remains your primary battleground. The IRS determines this using your combined income. $, text combined income, equals text adjusted gross income, AGI, plus text non-taxable interest plus FRAC 12 text total Social Security benefits, $. If you file as an individual and this metric falls below $25,000, or married filing jointly below $32,000, then 0% of your Social Security is subject to federal income tax. And remember this ironclad rule. Even if your wealth blows past these thresholds into the highest brackets, by law, a maximum of 85% of your benefits can ever be taxed. 15% of your Social Security is permanently, legally tax exempt for every American. So where is the trap? When you initially onboarded with the Social Security Administration, they handed you a document called Form W-4V. Out of a reflex of fear, wanting to avoid a surprise bill at the end of the year, millions of seniors checked the box requesting a voluntary withholding of 10%, 15%, or 22% directly from their monthly check. The financial consequence? If you fall within the exempt bracket, you are effectively giving the federal government an interest-free loan for 12 months out of the year. Yes, you get a tax refund the following spring, and it feels like a windfall. But that was your money all along. Why are you restricting your monthly liquidity and lifestyle for a tax debt you do not owe? I can already hear the objection. Carol, that sounds fine in theory, but if I don't withhold it every month, what happens if I miscalculate and owe thousands of dollars in a lump sum next April? The withholding is painful, but it feels safe. I respect the need for cash flow security. A massive, unexpected tax bill is an absolute nightmare when you're on a structured drawdown plan. But instead of letting the government hold your capital for free, apply this elite wealth management tactic, the private escrow strategy. Open a dedicated high-yield savings account, HISA, with an online institution like Marcus or Ally, which in 2026 are yielding strong 4% to 5% returns. Instead of filing a Form W-4V with the SSA, set up an automated monthly transfer from your primary banking account to this HISA, matching the exact amount you would have withheld. That capital remains yours, completely liquid, compounding interest daily for your balance sheet. Next April, if you owe a tax liability, you cut the check from this account. If you don't owe anything, the principal and the accumulated interest belong to you. Retain custody of your capital, never cede control to the IRS. To ensure your combined income never crosses into the taxable thresholds, use the buffer zone withdrawal technique. Instead of taking massive, lumpy distributions from a traditional 401k, which spikes your AGI and triggers the taxation of your Social Security, blend your distributions. Pull a portion from your Roth accounts or utilize loans against the cash value of a permanent life insurance policy. These inflows are completely excluded from the AGI calculation, keeping your Social Security check pristine and untaxed. Your immediate action item: go to ssa.gov, download Form W-4V, adjust your voluntary withholding to 0% if you do not owe the tax, and regain control of your monthly cash flow. Bill #3, property tax assessments. Now let's look at the third bill, property taxes. This is where affluent homeowners and asset-rich retirees lose massive amounts of capital. They assume that because they aren't low income, they don't qualify for property tax relief. This is a profound strategic error. Across the United States, municipal property tax relief for seniors generally falls into 3 categories. But the third one is your absolute financial juggernaut, the age-based assessment freeze. This mechanism is completely blind to your income or net worth. The moment you cross the age threshold, typically 65, the local tax assessor is legally mandated to freeze the assessed value of your primary residence. The real estate market outside your door can enter a hyperinflationary boom. Your neighborhood can gentrify, and your home's market value can double or triple over the next decade, but your tax assessment base remains locked in ice. Take Texas as a prime example. The moment you hit 65, your school district taxes, which represent the overwhelming majority of your property tax bill, are legally capped. Your net worth is completely irrelevant. You receive the ceiling because you lived to 65. period. Furthermore, there is massive news regarding property taxes integrated into the 2026 federal tax landscape. The SALT, state and local tax, deduction cap has been aggressively raised. For years, retirees were financially suffocated by the $10,000 cap on deducting state and local taxes, including property taxes, on their federal returns. But under the current extended provisions active through 2029, the SALT deduction ceiling has surged to $40,400 for 2026 for filers with a modified adjusted gross income, MAGI, below $500,000. Retirees often tell me with immense frustration, "Every time the county reevaluates my home, I lose sleep. Home values going up is great for my heirs, but it's actively draining my current cash flow. I've lived here for 30 years, and it feels like the county is trying to price me out of my own home." Listen to me. You are not moving anywhere. That home is your equity, your history, your anchor. Do not let the county tax assessor intimidate you. Take control with this exact protocol. Go to your county's official government website. It must end in .gov, such as harriscountyassessor.org. Search specifically for senior homestead exemption or over 65 assessment freeze. Download the affidavits. If your county requires in-person filing, bring 3 non-negotiable items: your driver's license to verify your age, your most recent property tax statement, and a certified copy of your property deed. Walk directly into the county assessor's office. If a clerk attempts to turn you away based on income thresholds, look them in the eye and say, "I am applying for the age-based assessment freeze under state statute." This program is asset independent. Be unyielding. It is your statutory right. With the SALT cap expanded to $40,400, your overarching tax posture completely changes. Previously, most affluent seniors defaulted to the standard deduction because their property tax write-off was choked at $10,000. Now, if you live in a high-tax state like New Jersey, New York, or California, instruct your CPA to run a comprehensive, itemized deductions analysis. Combining your newly uncapped property taxes up to $40,400 with out-of-pocket medical expenses that exceed 7.5% of your AGI can easily blow past the standard deduction, saving you thousands of additional dollars on your federal return. Yet, empirical data from AARP confirms that an astonishing 92% of qualifying seniors fail to file the paperwork. Out of millions of eligible Americans, only 8% are capturing this wealth protection. The other 92% are silently subsidizing the county's municipal budget. Why doesn't the county apply it automatically? Because every dollar they save you is a dollar removed from their spending pool. They have your data, but they prefer your silent compliance. Stop leaving your capital on their table. Bill Hash 4, Medicare Income-Related Adjustments, IRMAA. Our fourth bill takes us into the complex architecture of Medicare, exposing a rigid, algorithmic error built into the federal billing system that will cost you thousands if you don't manually override it. If your income during your peak earning years was substantial, Medicare imposes a steep premium surcharge known as IRMAA, Income-Related Monthly Adjustment Amount, on your Part B and Part D coverages. But the federal system operates on a severe structural delay. They look at your tax returns from 2 years prior to calculate your premiums for the current year. Consider the real-world friction this creates. At ages 63 and 64, you are at the zenith of your career, generating peak income. You hit 65, you formally retire, and your earned income drops off a cliff. But when your Medicare statement arrives, the billing computer assesses you based on the phantom income of 2 years ago when you were still working. They are charging you a premium surcharge based on money you are no longer making. And because this surcharge is quietly automatically deducted from your Social Security check before it even reaches your bank account, most seniors simply accept the loss month after month. A client once came to me in tears over this. When I saw my Medicare premium skyrocket by hundreds of dollars because of IRMAA, I panicked. I'm retired, my corporate salary is gone. How can they use my past to punish my empty wallet today? I called Medicare, and I just got stuck in an endless loop of automated recordings. Stop calling them. The automated telecommunication system is designed to induce fatigue, so you surrender the claim. We fight this on paper, using their own regulatory framework. Print out Form SSA 44 immediately. Go to Section 1 type of life-changing event and check the box marked work stoppage. In Section 2, enter your actual adjusted estimated income for this year, the deflated number reflecting your true retired status in 2026. Here is the professional execution secret. You must provide irrefutable documentary evidence. Attach a formal retirement letter from your former employer on company letterhead or last year's W-2 explicitly showing the cessation of wages. Send this package via certified mail with return receipt requested directly to your local Social Security Administration office. By law, this forces a manual review of your file by an actual caseworker. Once processed, they will completely eliminate the surcharge and retroactively credit your account for every overpaid dollar since the beginning of the year. I utilized this exact form to recover $220 a month for a retired high school principal. Medicare will never proactively mail this form to your house. You have to seize it. Furthermore, you must master the IRMAA cliff. Unlike federal income tax brackets, where only the money over the threshold is taxed at the higher rate, IRMAA is a strict cliff system. If your income clears a tier threshold by a single dollar, you are pushed entirely into the next premium bracket for the whole year. Your defense strategy? Every November and December, sit down with your wealth manager and run a precise projection of your modified adjusted gross income. If you are mashing against an IRMAA threshold, immediately deploy strategies to defer income or maximize charitable contributions. Restricting your income by a mere $100 at the end of the year can prevent a multi-thousand-dollar premium penalty the following year. Bill #5, Medigap premium inflation. Bill number 5 moves away from the government and directly into the private insurance markets, where corporate entities actively monetize your loyalty. To protect against the out-of-pocket exposures of traditional Medicare, most retirees purchase a supplemental policy such as Plan G or Plan N. There is a strict federal mandate you must understand. All Medigap policies with the same letter designation must offer 100% identical coverage by law regardless of the carrier. A Plan G issued by a massive multi-billion-dollar insurance conglomerate pays out the exact same claims, down to the penny, as a Plan G issued by a smaller, lean regional insurer. Yet, private insurance companies systematically raise their premiums by 5% to 15% every single year based on your age. A senior who onboarded at age 65 might look at their statements at age 72 and realize they are now paying $250 a month for their Plan G, while an equally rated, a highly stable competitor in their exact zip code is offering the identical Plan G to 72-year-olds for $150 a month. You are transferring $1,200 a year of your personal net worth to an insurance company for zero additional medical value. The primary psychological barrier here is medical underwriting anxiety. I know my carrier is bleeding me dry with rate hikes, but I developed a heart condition and type 2 diabetes a few years ago. If I drop this policy to switch to a cheaper carrier, they'll run me through medical underwriting and deny my coverage entirely. I'm trapped. That fear is exactly what the insurance companies count on to lock you into high premium plans. But here is your golden key. If you reside in a state that enforces the birthday rule, such as California, Oregon, Nevada, Idaho, Illinois, Louisiana, or Kentucky, the law grants you an absolute shield. On the month of your birthday, and extending 30 to 60 days past it, you possess an unconditional right to switch your policy to any other insurance carrier in the state for a plan of equal or lesser benefits. The new carrier is legally prohibited from conducting medical underwriting, cannot look at your pre-existing conditions, and cannot deny you coverage. Mark your birthday on the calendar in bright red ink. It is no longer just a celebration of age. It is your annual window of financial liberation from insurance cartels. If your state does not currently feature a birthday rule statute, look for carriers offering household discounts if both spouses transition to the same company. Your tactical move here is to leverage an independent Medicare broker. Unlike captive agents who work for a single company, independent brokers utilize multi-carrier software to instantly scan every single premium rate inside your specific zip code. Never show loyalty to an insurance corporation. Show loyalty strictly to your balance sheet. Bill #6. Retail tax preparation fees. Finally, let's audit the sixth bill, retail tax preparation fees. Every spring, I witness millions of retirees walk into retail tax preparation chains carrying a simple envelope containing a social security statement, a standard pension distribution form, and perhaps a basic one, 099 INT. They sit there for 30 minutes while an hourly worker inputs data into a software program, and then they hand over $200 to $500 for the privilege. This is an egregious waste of capital. People tell me all the time, it kills me to pay that tax storefront down the street $350 every year. That's a week's worth of groceries for my spouse and me. But the alternative is terrifying. If I try to do this myself at home, I get completely overwhelmed by the changing tax codes. You need to sever your relationship with commercial retail tax preparers immediately. Unless your estate involves active commercial real estate portfolios, complex corporate entities, or multi-state K-1 distributions, the federal government has funded a flawless, complementary solution, the TCE, Tax Counseling for the Elderly program. Managed and funded directly by the IRS, TCE operations, most notably executed through the AARP Foundation Tax Aid Network, utilize tax counselors who undergo rigorous, specialized training focused entirely on the unique nuances of retirement tax law. They understand the complexities of required minimum distributions, RMDs, and they understand the mechanics of the new 2026 senior bonus deduction far better than a seasonal worker at a retail strip mall chain. Crucially, you do not need to be a member of AARP to use this service. It is completely free for any filer aged 60 or older with a low to moderate or middle class income profile. The execution is simple. Go to irs.treasury.gov/freetaxprep or call the AARP Foundation Tax Aid Locator hotline. Input your zip code and the database will display certified free tax preparation sites operating right inside your local public library, community center, or neighborhood church. You simply schedule an appointment, place your documents in an envelope, and let a highly trained specialist optimize your return for zero cost. Keep that $350 in your portfolio where it can work for you. If your net worth and income profiles exceed the thresholds for the TCE program, but your tax architecture remains relatively straightforward, do not buy expensive retail software. Maximize the IRS Free File portal, available to anyone with an AGI under $79,000, or utilize the IRS Direct File platform. Furthermore, if you are managing a high net worth estate intended for your heirs, the pro-growth tax architecture of 2026 has expanded the federal estate tax exemption to an extraordinary $15 million for individuals and $30 million for married couples. This means you can execute wealth transfers with absolute confidence, avoiding the steep overhead of complex defensive trust structures that are entirely unnecessary if your aggregate assets sit below these high ceilings. Your strategic action protocol. My friends, I know you are tired. After 40 years of working, managing businesses, raising families, and paying into the system, the last thing you want to do is fight an administrative battle to reclaim your capital. But you must understand this fundamental truth. The modern financial architecture was not engineered to be automatically benevolent to you. It functions on your inertia. Your silence is their profit margin. The sweeping tax reforms of 2026 under President Donald Trump have handed us an incredibly sharp array of financial weapons, but you have to be the one to pick up the shield. The only thing standing between your legal rights and the preservation of your wealth is execution. This exact week, I want you to step away from the daily routine, pick up your files, and execute these 3 core protocols. Schedule a session with a certified TCE site or your wealth manager and demand the execution of Form Schedule 1A to capture your $6,000 to $12,000 senior bonus deduction. File your formal application with your county property tax assessor to lock in your age-based assessment freeze and have your CPA audit an itemized approach to exploit the new $40,400 SALT limit. Execute Form SSA 44 with your corporate retirement documentation to permanently strike down the IRMAA Medicare surcharges and coordinate with an independent broker to align your Medigap policy with your upcoming birthday window. Do this for your portfolio, your peace of mind, and the dignified, autonomous retirement you spent an entire lifetime earning. And if you know a friend, a former colleague, or a neighbor over 65 who is quietly writing these checks every month with a sense of dread, take this information and hand it to them. We have to look out for one another in a system that thrives on institutional silence. Thank you for your time today. Keep your capital exactly where it belongs on your balance sheet. I'll see you in the next Wealth Strategy Brief.